Thank you very much for joining us once again. This is our 16th lectures on financial management, 11th lectures on working capital, and second lecture on debtor management. We have already discussed debtor management is the process of designing and implementing policies to grant credit to the customer and getting money from the customer on timely basis, to increase sales and to reduce the chances of bad debts. These are the core objectives of the debtor management: increasing sales and reducing the chances of bad debts. We have already discussed debtor management. There are two main policies. What is credit granting policy, and the second one is a debt collection policy. In the credit granting policy, we have already discussed how to set the credit limit, what are the factors that require to be considered while setting the credit limit. We have already discussed what are the terms, what are the conditions, what are the parameters that require to be considered while giving extension in the credit limit. Today we are starting debt collection policy, and there are two very simple, we can say, categories. Amount is being paid by the customer on timely basis. Amount is not being paid by the customer on timely basis. If the amount is being paid by the customer on timely basis and sometimes there are delays in the payment, then simply you can give a follow-up call to the customer and request a payment. This follow-up call can be in the form of email, it can be in the form of phone as well. Then customer will release the payment. It means customer is a good paying master and customer will timely release the payment, just they are in need of a simple reminder. In case you are following the customer and customer is not paying the money, once the customer is not paying the money, then there are different techniques to collect the money from the customer. And the first technique is early settlement discount. Second is the credit insurance. Third is the factoring. Fourth one is invoice discounting. And these techniques, it is not compulsory that customer is not paying money, then you need to apply these techniques. You will be doing the cost benefit analysis as well to consider that you need to get the money from the customer before the due date. You need to go for credit insurance. Might be sometime you are in need of finance, you are going for factoring. In the same time you are in need of finance, you are going for invoice discounting as well. So these are the different techniques with the help of which you can increase your cash flows, manage your debtors, which will reduce the chances of bad debts as well. So out of these four techniques, the first top is early settlement discount that we are going to discuss today. Early settlement discount is known as the prompt payment discount or early payment discount as well. This is the discount usually being offered. This is the discount being offered to the customer to pay before the due date and get some sort of discount. This is typically calculated as a percentage of the goods or services sold. And this is expressed in 2/10 net 30 days. This reflects customer will get 2% discount if the customer is making payment within 10 days, but the normal credit terms are 30 days. For example, you are supposed to receive $1,000 from a customer within 30 days. You are giving them 2% discount in case the customer is paying within 10 days. So if the customer is paying within 10 days, customer will pay $980. If the customer is paying after 10 days, customer will be paying $1,000. So in case the customer is paying within 10 days, customer will be getting discount of $20. So what are the advantage of early settlement discount? The biggest advantage is improving the cash flows of the supplier. It will improve your cash flows. You will be able to manage your cash properly. You will be able to invest. You will not be skipping any opportunities where you have an opportunity to invest the money. Second, timing. The timing is supplier will always do the analysis and take a decision at the time of making offer. What are the cost benefit analysis? So supplier will do the cost benefit analysis also. Supplier will assess what will be the benefits by offering the discounts and what will be the cost by offering the discount. In case the benefits are greater than the discount, then supplier will offer this, otherwise supplier will not offer this. What are the effects? Whenever the supplier is offering early settlement discount to the customer, there are chances that volume of demand can go up or it can come down as well. Might be the customer, 100% customer will avail this discount, might be the customer will not avail this discount. So out of these four things, the most important thing is the cost benefit analysis. To assess the cost benefit analysis, just take this example. This is a situation 0, 30 days, 60 days, 90 days. If we are offering 2% discount to the customer in case payment is being made within 30 days, so how will do the cost benefit analysis? So customer will be paying the money at this point. The amount that was supposed to receive after 90 days, we are receiving this at the end of 30th day. In case we are receiving the money from the customer at the end of 30th day, so we need to offer a discount to the customer. Whatever the discount that we are offering to the customer, this discount will become my cost, will become supplier's cost. So this is the time period of 60 days. During this time period, as I discussed earlier, the cash that was supposed to receive at the end of 90 days, you are receiving it at the end of 30th day. So you are receiving cash 60 days earlier. Now there are two possibilities for this cash. What are the receiving? Might be you have a loan from the bank. In case you have a loan from the bank, you will pay early settlement to the bank and you will avoid the interest cost. So I can say here there are chances it can be interest cost saving. On the other way around, if you have any investment opportunity, then the amount that you are receiving from the customer 60 days before the due date, you will invest that amount somewhere. Whenever you will invest that amount, you will be earning interest as well. Interest income. So saving can be interest saving, which is being paid to the bank. You can save the interest, or interest income, you can invest the amount and earn the income. So it will be my savings. So this will be saving, this will be cost. I will compare the cost versus savings. If my cost is higher than the saving, definitely I will not offer the discount. Supplier will not offer the discount. If my savings are higher than the cost, then definitely supplier will offer the discount. So we can say early settlement discount, there are two possibilities. It doesn't affect the volume of demand. It will affect the volume of demand. If early settlement discount which is being offered to the customer, it will not affect the volume of demand, then I can do the cost benefit analysis on absolute value basis or through the formula. There are two chances. If my demand will remain unaffected, then I can do the cost benefit analysis through the absolute value method or the formula method. In case I am doing the cost benefit analysis through the absolute value method, then decision will be based upon the value. If the savings of the suppliers are higher than the cost of the supplier, then supplier will go, otherwise the supplier will not go. In case we are applying the formula method to do the cost benefit analysis, this will give me the result in percentage that we'll discuss in detail in next slide. In case early settlement discount will have an effect on the volume of demand, then we have only one option to do the cost benefit analysis, and this option is absolute value method. Decision will be based upon the value. If my savings are higher than my cost, then supplier will take the decision that they need to go ahead and offer the earlier settlement discount. Otherwise supplier will not offer earlier settlement discount. Let's take this example where the volume of sales will remain unaffected. I have taken this example from ACCA P4 book. Lowy and Price has annual credit sales of $12 million and they have 3 months are allowed for payment. The company decides to offer 2% discount in case the payment is being made within 10 days and to reduce the maximum time allowed for payment to 2 months. It is estimated that 50% of the customer will take the discount, and if the company requires 20% return on investment, what will be the effect of the discount? Here demand, as we discussed earlier, demand is unaffected. Once the demand is unaffected, we have already discussed there are 2 possibilities. We can take the decision based upon the absolute value, or we can take the decision based upon percentage as well. Here is a solution. The decision will be based on the following: profit foregone, which is a cost; interest charges saved, which are savings. If the savings are higher than the cost, then supplier will take a call, otherwise supplier will not offer the discount. Existing receivables are 3 million. How it has been calculated: $12 million are the sale. Payment terms are 3 months. 12 million into 3 by 12. 3 million are the existing receivable. Revised receivables are 1.164384 million. 1.164384 million. How it has been calculated, we have already discussed. Out of this existing receivable, 50% of the customer will take the discount and they will process payment within 10 days. Remaining 50% they will process the payment within 2 months. So my revised receivables are 1.164384 million. Reduction in receivable is 1.835616 million. And we know this, that the customer can invest this amount at 20%. So 1.385 into 20%. This is the savings annually, 367,123. What is the cost of the discount? 12 million. 50% will take the discount into 2%, 120,000. So net savings are 247,123, and the decision is go ahead and offer the discount to the customer because savings are higher than the cost of the discount. This is, we have applied the absolute value method. We've already discussed supplier can do the cost benefit analysis based upon the percentage as well. In case annual demand is unaffected, supplier can take a call based upon the percentage. Supplier will be able to decide either they need to offer a discount to the customer or not. This is called percentage based method. And to understand the percentage based method, we need to understand this example. In this example, it has been given company offers goods to the customer on 30 days credit. Normal payment terms are 30 days. It offers 2% discount if the payment is being made within 10 days from the date of the invoice. This example I have taken from the ACCA P4 book as well. So we can say 2/10/30. 2% discount if the payment is being made within 10 days and normal payment terms are 30 days. To understand this example, how this 44.6%, which is the cost to the supplier, has been calculated, we need to look into this. Assuming $100 is the receivable within 30 days payment terms. 2% discount is being offered in case payment is being made within 10 days. So 20 days before the due date, supplier would be getting 98. So if we can say simple discount rate or cost to get 98, 20 days before the due date is 2 divided by 98 into 100. So it would be 2 divided by 98 into 100. It would be 2.0408%. This is the cost for getting 98 20 days before the due date. Now we need to convert this into the annual cost by applying effective interest rate formula. Effective interest rate formula is APR, annual percentage rate, is equal to 1 plus I raised to the power plus n minus 1. We'll discuss this formula in detail when we'll discuss the time value of money in the next lectures. Here APR stand for annual percentage rate, I stand for interest rate, given interest rate, N stand for number of periods in a year. 1 plus given interest rate is 2.0408% raised to the power. How many number of periods are in a year? Given are 365 days in a year divided by 20, because we have got the payment 20 days before the due date, minus 1. So it would be 1.020408 raised to the power 365 divided by 20, 1.4458 minus 1, which is equal to 0.4458, or we can say 44.58%. So this is the annual cost of the supplier. If the supplier has an opportunity to invest anywhere where supplier can earn more than 44.58%, supplier can move ahead and offer a discount to the customer. If the supplier can pay back to the bank and can save more than 44.58% annually, then supplier needs to offer this discount. In case supplier doesn't have any opportunity to invest and earn more than 44.58%, and in case the supplier cannot save by offering earlier payment back to the bank, in case the supplier has already taken the credit more than 44.58%, then the supplier should not offer this discount to the customer, because this is the minimum cost to the supplier. So thus you will be able to know how this 44.6% has been calculated. Basically 44.6% is the annual interest cost to the supplier. Let me apply the same pattern, let me apply the same formula on the previous example that we have discussed, because annual demand is unaffected. So discount rate in the previous example is 2% discount is the payment made in 10 days. Normal payment term, they will reduce it to 60 days. So assuming receivable is 100, discount given on every 100 is 2, because 2% is the discount. Net received is 98. Simple discount over 50 days. Why 50 days? Basically normal payment terms are 60 minus 10, 50. So it would be 2 divided by 98 into 100, which is equal to 2.0408%. Now I need to convert this 2.0408% into the formula. How can I convert this through the formula into the annual interest rate? Formula is APR is equal to 1 plus I raised to the power n minus 1. So 1 plus I given I is 2.0408% raised to the power 365 divided by 50 minus 1. If I am calculating this, it would be 15.891%. So this is the annual interest cost over 1 year. So annual investment rate given in the question was 20%. So my cost is lesser. Cost is lesser than savings, or I can say savings are greater than cost, then definitely supplier can move ahead and supplier can offer the discount to the customer. Thank you very much for joining us. Today we have discussed early settlement discount by applying percentage method, by applying absolute value method in case the annual demand is unaffected. In our next lecture we will discuss in case there is a change in the annual demand. Once there will be change in the annual demand, there are possibilities that it can be change in the bad debts as well. Then in our next lecture we will discuss early settlement discount, change in policy in case there is a change in the annual demand, and what will be the effect. So supplier needs to offer this discount to the customer or not. Thank you very much for being with us. Have a lovely day. Thank you. Bye bye.
Thanks for watching the video. Click on the bell and subscribe to the YouTube channel.